All right, let's just cut right to the chase today. We're tearing down the financials of one of the biggest AI darlings out there right now, CoreWeave. Look, if you follow the tech space, you already know the story, right? Everyone is screaming that demand for compute power is just insatiable, and these neocloud companies are practically printing money. But, and this is a massive but, beneath all that explosive growth, there's a staggering $35 billion risk that almost nobody is talking about. So today, we're cutting through the hype. We're looking strictly at the cold, hard numbers, the cash flow, and the balance sheet. Are they building an unstoppable AI empire, or are they hiding a multi-billion-dollar trap? Let's start with a fast reality check. When you pull up the chart for CoreWeave, ticker symbol CRWV, honestly, it's pretty easy to get swept up in the optimism. Since its IPO about 15 months ago, the stock is up an impressive 122%. It's currently sitting at a massive $48.49 billion market cap. Even year-to-date, it's up over 12%. But zoom in on that one-year performance, and you'll see some extreme turbulence. We're talking down nearly 33% over a 12-month window. And that volatility, that is our first major clue. Because underneath that long-term green chart and behind that massive $48 billion valuation lies a staggering $35 billion debt risk. To understand how a company can be worth that much while carrying so much baggage, we really have to look at their top line.
Now, on the surface, the bull case looks absolutely bulletproof. Just look at the sheer velocity of this revenue growth. It is staggering. We are talking about a jaw-dropping 10x multiplier in just 24 months. Back in Q1 of 2024, they were pulling in, a respectable $188 million. Fast forward to Q1 of 2026, they are projected to hit $2.078 billion in a single quarter. For us as retail investors, this is exactly the kind of exponential growth curve you dream of finding, right? It perfectly validates that whole narrative that AI infrastructure demand is infinite. But top-line revenue is only half the story. The real measure of a company's health is what they actually get to keep.
And here is exactly where the mirage starts to fade and the profitability paradox begins. While the revenue expands to over $2 billion by Q1 2026, notice what's happening on the bottom here. Net income plummets in the exact opposite direction, hitting a negative $740 million in that same quarter. They are operating at a net margin of negative 35.61%. So what does this actually mean for your wallet as an investor? It means that right now, scale is not solving their profitability problem. Actually, scratch that. It's making it worse. The bigger CoreWeave gets, the more money they are actually losing on an absolute basis. Let's put that profitability paradox into plain English. No financial jargon needed. For every $2 billion coming in the front door in revenue, they are bleeding almost $750 million straight out the back door in losses. Literally. Imagine running a lemonade stand where the more cups you sell, the deeper into the red you go. That is the exact reality of CoreWeave's current business model. So it really begs the question, where exactly is all this cash going?
Well, a major culprit for this cash drain is aggressive reinvestment, or what we can probably just call the research and development black hole. Notice how this R&D expense line consistently eats up over half of all incoming dollars. Back in Q1 2024, it was around 49.2%, but by Q1 2026, it's projected to reach a massive $1.273 billion. That is 61.2% of their total revenue. Now look, in the highly competitive neocloud and AI infrastructure space, you absolutely have to innovate to survive, we get that. But spending over 60 cents of every single dollar you make just on R&D, that leaves dangerously little room to cover your other basic operating expenses, let alone turn an actual profit. And honestly, R&D isn't even their biggest expense. Beyond research, they are essentially mortgaging the future with a massive CapEx burn. CapEx, or capital expenditure, that's just the cash a company spends to buy physical assets. For CoreWeave, it means buying the actual servers, those highly coveted NVIDIA GPUs, and the massive data center infrastructure you need to keep this AI dream alive. In Q1 2024, CapEx was $1.742 billion. Jump to Q1 2026, and they are spending a staggering $7.695 billion in a single quarter. This is just the brutal reality of the AI infrastructure game. You have to spend billions upfront on hardware before you can sell a single ounce of compute power to your customers. So the absolutely crucial point here is what happens when we combine their operational cash with that massive CapEx bill. In Q1 2026, sure, they generate a very healthy $2.984 billion in operating cash, but
That towering CapEx spend completely wipes it out. And that leads us to probably the most concerning piece of historical context we've seen yet. Take a look at this deep freeze reality. Free cash flow has been negative in 8 of the last 9 quarters. I want to let this number sink in for a second. Negative $4.711 billion in free cash flow for just one single quarter. This isn't just a small leak in the boat. It is a geyser of cash blasting out of the company. When a business has deep negative free cash flow like this, they literally cannot fund their own growth organically. They have to go find that money from outside sources just to keep the lights on and the servers humming. And that, my friends, brings us to the absolute most dangerous part of this entire explainer. To plug that colossal, multi-billion-dollar cash hole, CoreWeave has built a literal mountain of debt. Look at this terrifying leverage gap right here. Cash and equivalents, sitting at roughly $3.042 billion in Q1 2026, but their balance sheet debt has exploded to $35.147 billion. Let that click. They have nearly 12 times as much debt as they do cash on hand. This is exactly how they're funding that massive CapEx spend we just analyzed. They are borrowing billions upon billions of dollars to buy servers today, just praying that future revenue will eventually catch up. But here's the catch. That strategy creates a suffocating anchor because it forces them to pay massive amounts of interest to the banks. Notice how this interest expense as a percentage of revenue is growing so rapidly. In Q2 2024, it was 16.88%. By Q1 2026, it is a crippling 25.79%. This is what we call an interest load. Before they pay for R&D, before they buy a fancy new server, before they even turn on the AC in the data center, they have to pay this interest just for the privilege of holding that debt. Let's break down exactly what that 25.79% interest ratio means for the company's fundamentals. It means more than 1 out of every $4 earned by CoreWeave goes straight to the bank to service debt before a single employee is even paid. Think about the intense pressure that puts on a business model. You essentially have to run flawlessly, with zero hiccups in client demand, just to tread water when your debt obligations are this heavy. And that brings us to the ultimate question, perfectly illustrated by this cycle right here. Is CoreWeave building an unstoppable AI revenue flywheel, or are they trapped in a debt death spiral? On one hand, yeah, they have unprecedented revenue growth. But to keep that up, they are forced to spend massively on R&D and CapEx, which creates a massive cash burn. To cover that burn, they need to take on more debt. More debt means higher interest expense, which loops right back around to crushing their net income, forcing the whole cycle to start all over again. Their entire investment thesis relies completely on breaking this loop before the debt becomes unmanageable. So how do we actually grade this? Well, the final investment verdict boils down to how you interpret this exact data. On one side, you have the bull view. If you believe the demand for AI compute power is truly infinite, you might think they can eventually outgrow this CapEx cycle, flip to profitability, and pay down that debt. For those supercycle believers, this stock is a speculative hold. But on the flip side, we have the bare reality. A $35 billion debt load and a $4.7 billion quarterly cash burn leaves absolutely zero margin for error. If AI demand cools even slightly, that debt anchor will sink the ship. For fundamentally driven investors who prioritize cash flow, this is a clear high-risk sell. So I turn the question to you, looking at the sheer scale of the revenue growth versus the reality of a $35 billion debt mountain. Is CoreWeave a supercycle hold or a high-risk sell for your wallet? Are they building the future, or are they a billion-dollar trap just waiting to snap? Drop your verdicts in the comments below. I would absolutely love to read your theories on this one. And hey, if you want to keep seeing past the hype and looking at the real numbers, make sure to hit subscribe for more deep dive financial explainers. Thanks for learning with me today, and I'll see you in the next one.